Hi everyone, I am Sam. Today we are going to talk about debt restructuring. Debt restructuring can sound like a complicated financial term, but at its core, it's a way of renegotiating the terms of debt to make it easier for a borrower to repay. Think of it as giving someone struggling to pay back a loan a chance to breathe, either by lowering the interest rate, extending the repayment period, or even reducing the total amount owed. It's a process that helps prevent a complete financial collapse, allowing both the borrower and the lender to find common ground and avoid worse outcomes, like bankruptcy. When we hear about debt restructuring, it's easy to imagine a large corporation or even a government struggling to balance its books. But the concept applies to all kinds of borrowers, whether a person, a company, or even an entire country. The process is typically initiated when a borrower can no longer keep up with the current terms of the debt due to financial difficulties. Instead of letting the situation spiral into default, restructuring aims to find a solution that allows everyone to walk away with something. One of the key ideas behind debt restructuring is the concept of distressed debt. This occurs when a borrower is unable to make timely payments and the debt is at risk of becoming unmanageable. However, rather than forcing the borrower into bankruptcy or seizing assets, restructuring offers a middle ground. It's similar to when a person has maxed out their credit cards, but negotiates with their bank for lower payments or a deferred balance. Now you might wonder, how did we arrive at this idea of debt restructuring? To understand how this concept developed, let's take a brief look at its historical evolution. The idea of managing and renegotiating debt has been around for centuries, long before it became a formal financial practice. If we go back to ancient civilizations, for example, the Babylonians had a kind of debt jubilee, where debts were forgiven after a certain period. The idea was that if people were forever trapped by their debts, the economy would stagnate, so occasionally wiping the slate clean was seen as a way to ensure the system kept moving. In more modern times, debt restructuring became more formalized with the rise of corporate and sovereign debt in the 19th and 20th centuries. Early on, during the Industrial Revolution, businesses began taking out loans in much larger quantities to finance their expansion. Some of these companies, as they grew, struggled to repay. And governments, too, faced similar issues, particularly after the devastating effects of wars, like World War I, which left many European nations deeply in debt. One of the major turning points came in the 1980s. This was a time when Latin American countries like Mexico, Argentina, and Brazil found themselves struggling under the weight of massive foreign debt. The loans they had taken out to finance development had become unsustainable, and the interest payments alone were draining their economies. The solution? Debt restructuring on a grand scale. In 1989, the Brady Plan, named after U.S. Treasury Secretary Nicholas Brady, helped many of these countries renegotiate their debt. This plan allowed nations to reduce their debt burden or extend repayment periods, helping them recover without plunging into economic collapse. The success of the Brady Plan highlighted the power of negotiation in international finance. Fast forward to the 2000s, and debt restructuring became even more commonplace. Governments, especially in the developing world, were finding themselves burdened with loans they simply couldn't repay under the original terms. But while debt restructuring had saved many from economic ruin, it didn't always come without controversy. Some critics argue that restructuring allows borrowers to avoid the consequences of poor decision-making, leading to moral hazards. Others say that it's the only way to prevent economic collapse in some cases, especially for countries too big to fail. While countries and corporations were learning how to negotiate their way out of debt, another important development was taking place on a smaller scale: personal debt restructuring. Consumers, struggling with credit card debt or mortgages, found that negotiating with lenders could be a way out of financial distress. This was a bit like the average person approaching their bank to ask for a lower interest rate or a temporary payment break. It wasn't an easy process, but it became more popular in the wake of financial crises like the 2008 Great Recession. One of the most significant challenges in debt restructuring, however, is determining the balance between the interests of the borrower and the lender. After all, a lender doesn't want to simply wipe out the debt. They expect to be repaid. But if the borrower is in a position where repayment is impossible, then continuing to enforce the original terms is just a way to hasten their financial ruin. This delicate balance is at the heart of the debt restructuring process, and it's what makes the negotiations so difficult. It's like negotiating with a friend who owes you money but is on the verge of losing everything. You don't want to be too harsh, but you also want to make sure you're treated fairly. But the process isn't always straightforward. Sometimes debt restructuring can lead to a credit event, which could impact a borrower's credit rating or trigger insurance policies. Imagine if, instead of simply lowering your monthly payments, your bank decided to declare your debt restructured and announced it publicly. It could make future borrowing more difficult, even though you might be better off in the short term. For countries, this could mean a loss of access to international capital markets for years to come, further complicating the economic recovery. As for the future of debt restructuring, experts continue to explore new ways to handle growing debt burdens. One area of interest is the use of technology, especially blockchain, to streamline debt restructuring processes. The hope is that technology could make negotiations more transparent, efficient, and secure, offering new ways for borrowers and lenders to settle their differences. Despite the advancements, there are still many open questions. How should countries with different economic structures be treated equally when it comes to debt restructuring? Can we truly find a universal system that works for both small borrowers and entire nations? And most importantly, how do we make sure that those who benefit from debt restructuring don't just return to borrowing unsustainably? Debt restructuring isn't a perfect solution, but it offers a glimmer of hope in times of financial crisis. Like the philosophers and economists of the past who struggled with ideas of fairness, risk, and reward, today's experts continue to wrestle with these same questions. The story of debt restructuring is still being written, and the debate over how to balance the interests of borrowers and lenders is far from over. In the end, debt restructuring is not just about numbers and financial models. It's about people, communities, and economies that need to find a way to bounce back from tough times. Whether it's a person trying to clear credit card debt, a company facing a mountain of unpaid loans, or a nation working its way out of a financial crisis, debt restructuring is a tool that can make the difference between economic survival and collapse. And like so many solutions in life, it's all about finding the right balance, something that continues to be as much an art as a science. That's it for today, and I'll see you in the next episode.